a lot of people right now, to make ends meet or to put themselves in a position to make the moves that they want to be able to make, have to engage in some outside income outside of their main job.
Mm-hmm.
For some people, that's their income, is a series of what some people refer to as side hustles, right? Uber, Uber, a lot of folks do Uber.
Right. Mm-hmm. Lyft.
Uber, Lyft, currency exchange, right? You know about that, right? Forex. DoorDash, all these things are side hustles that people make real money, on it. And when people, give me their income for qualifying for a home, generally they will just give me their main job. Or they may say, hey, listen, I also do this on the side. But when you are working a job or working a supplemental employment, that income, particularly if it's not W-2 income, they pay you as a 1099 employee or a contractor. Or if you're getting money under the table, you're doing hair on the side, cutting heads, whatever the case may be, making real money, it's great for your bank account. But if it's not on paper,
right, you can't track
on your tax returns, you're not going to be able to use it when it comes time to buy a house, right? And so, irrespective of the fact that if you don't want to get in trouble with the tax with Uncle Sam with regard to paying taxes, there's still like a bit of an equation, right? Sometimes people are so focused on avoiding taxes,
right? The write-offs,
right? They have some income because they get that 1099. If you get a 1099 from the company, you can't avoid that. You've got to put that on your tax return because the IRS is going to find out about that. But then a lot of times people intend to inflate their expenses related to that additional income. So they might make 30 grand of additional income through these side hustles, but then they write off 30 grand of expenses, right?
Pocket the money, right?
So when they show me that, I can't use that, right? To qualify. More power to you if you keep more of that money in your pocket. But at the end of the day, think about it. If you only wrote off $15,000, right? Now you're going to pay taxes on that other 15, but the taxes on 15,000, maybe even if you're in a more of a mid-range tax bracket, it's 25, roughly 24%, maybe 26%. You're paying $3,000-$4,000 in taxes on that money, on that extra money. But by not showing that income, first of all, you subject yourself potentially to IRS audit down the line, right? If they ever catch up to you and you truly don't have $30,000 of expenses to document, you're going to have some problems down the line. So that's a risk you can avoid by, not reporting all these excess expenses. But also when it comes time to, come to us to buy a house, to get financing, having that extra $15,000 worth of income can mean the difference between qualifying for, say, maybe $300,000 and $350,000 on a house. And maybe you can't find the house that you need for $300,000, but at $350,000, there's a lot more houses available to you, right? So that extra write-off, saving that $3,000 in taxes, kept you in an apartment or kept you in a rental situation and kept you out of the housing market. So was it worth it? Right. Maybe it was worth it to you, right? I don't know. You got to make that. You have to be smart. You have to think about the whole picture.
Right. Especially if you're getting ready to buy. You want to play you want to do the long play as opposed to the short term.
And so the other thing, so you there are programs, right, where you can buy a home without documenting your income in the traditional way. All right. We do have things called bank statement loans now. All right. It's illegal. We basically can no longer. We used to hear about stated income. Heard about that back in the day. People just stated on the application.
Okay, yeah.
That's how I make this. And so if your credit score was good enough, the lender would basically just say, okay, I believe you, and then give you a loan based upon what you stated on your application.
And now we run into
enough money down, you had right, exactly. And then we had all that meltdown. So we can't do that anymore. The government outlawed that. It's illegal to do a loan that does not factor in the borrower's ability to repay and it be documented. So the way we the way we address that typically is through traditional underwriting. I need to look at your pay stubs. If you're self-employed, I need to look at your tax returns, calculate it in a consistent manner. Income needs to be projected as able to stable and continuing, for the foreseeable future.
Right.
Some people, because of what we've been talking about here, or for other reasons, aren't able to show that on their tax returns. Right. They have self-employment income, but it doesn't equal what on paper what they truly bringing in.
Right.
And so we have like bank statement loan programs. Bank statement loan programs mean that we can look at your bank statements for 12 or 24 months, and we look at the deposits coming into your account. They're able to look at the deposit and determine the deposits that are likely to be like income related deposits. They don't just take any deposit into your account, whereas clearly you took a loan or something like that and put it into your account, or a refund of a rebate of a purchase or something like that you made. But they look at the bank statements and they will calculate your total deposits, and depending upon the type of industry that you're in, apply an expense factor to it, and then use that number as the amount that we can use to qualify you for your income. Now,
wow.
So if you've got good income coming in on your bank statements, even though your taxes don't show it, we can do that. We can use that to qualify. Downside is two things. One, you got to put more money down.
Okay.
Than on a regular loan. Like on a regular loan, you could put 3% down. You can even put, you can get a first-time home buyer program or something that gives you the down payment assistance, so you may not even have to put hardly anything down. But you have to put more money down if you use one of those bank statement loan programs, and the interest rate's higher. So you're still paying one way or the other, right?
The risk is higher.
You avoid, if you're hiding from Uncle Sam and you get ready to buy a house,
they're gonna make you pay for it.
You're gonna pay more. Actually,
you gotta pay to play.
Taxes.
You gotta pay to play. Right.
Right. Exactly.
Right. So, is there a minimum amount of deposits that need to be that has to be on your bank statements in order to take advantage of something like that?
It's not a minimum, but obviously you would think that unless it's got to be in line with being able to afford a mortgage payment.
Right.
It's just like the same thing. If you have $10,000 of income, you generally, and on a regular loan, you generally can afford a mortgage payment of maybe $3,500, $4,000 a month, depending upon what your other debts are. Same thing with a bank statement program. We, depending upon the type of mortgage that you're trying to obtain, we're still going to apply pretty standard debt to income ratios. Your mortgage payment and your other debts can only equal a certain percentage of your income. So, like if you only have $2,000 a month going into your bank,
right?
You might be able to qualify for a $500 mortgage payment.
So, are we talking 20% down, 10% down? What are we talking?
Some of the banks, there's some bank statement programs that might go as high as 10% down. Probably usually 15.
Okay.
For the most part, but some will go at 10% down. But again, the less you put down in a loan where you're not doing traditional underwriting, higher the risk from a lender's perspective. So as a result, you have a higher interest rate.
Because it's a higher risk.
Right, and higher payment.
Makes sense. So are these loans, are they still conventional routes of financing? Or is it, because you can't do government, you got to assume.
Yeah, exactly. These are what's called non-conforming loans, right? They are conventional loans because they're not government loans. They're not backed by the government in any way, shape, or form. They don't even have a quasi governmental backing of Fannie Mae or Freddie Mac, which aren't government organizations, but they're called government-sponsored entities.
Right.
These are loans that are funded through private money, no real government backing. Mm-hmm. So they're non-conforming loans. They're able to have, as a result of not having that government backing, that's part of the reason why the interest rate is higher.
Right.
It's higher because you're not doing the standard documentation requirements, so there's more risk involved. And there's also, essentially no government backing for these loans, which doesn't mean anything. The government backing just helps the lender. It doesn't help the borrower.
Right.
The fact that my loan may be backed by the government and yours isn't, doesn't make a difference to me. It's just that it makes a difference to me because when I got the loan, it was probably cheaper.
Right.
Because of that
implicit
or explicit government guarantee.